Hello, I'm Bernard Hickey from interest.co.nz and welcome to a special economic weather report brought to you in association with ASB. I'm here at the Reserve Bank's building in Wellington, just after the press conference where the Reserve Bank has announced a 150 basis point cut in the official cash rate to 5%. This is a record cut and comes after the Reserve Bank has reduced its forecast for economic growth and has also cut its forecast for inflation. The Reserve Bank is saying there is even a danger that inflation could have dropped below its 1 to 3% target band. That means, of course, that the Reserve Bank had plenty of room to cut the official cash rate to give the economy a boost, and it really does need a boost. We're seeing global economic growth slowing rapidly, particularly in emerging economies, but also in our major trading partners, such as Australia, the United States, Japan, and most of Europe. They're all going into recession. That means the Reserve Bank also is seeing slow economic growth here being accelerated downwards by this global recession. On the inflation front, the Reserve Bank says that lower fuel prices and commodity prices will help drag inflation lower over the next year to 2 years, and that it will be inside the 1 to 3% target band by the middle of next year. Now, the Reserve Bank says that it may cut the official cash rate again, but in much smaller amounts than it has this time around. Remember, 150 basis points is a record move in the history of the official cash rate. The Reserve Bank says that there is a possibility of further downside in both the economic outlook and the inflation outlook, and therefore it would look to cut the official cash rate again, but in smaller amounts. Now, many economists are saying the Reserve Bank could cut the official cash rate as low as 4%. So what does this mean if you've got a mortgage or a term deposit? Now, if you've got a fixed rate mortgage, let's say it's a 2 or 3 year mortgage and it's about to roll over, what you'll find is now the shorter term fixed rate mortgages are cheaper than the longer term ones. And that's because the Reserve Bank has dropped the short term of the yield curve, as we call it. That means it's more attractive to go shorter term, and eventually we could see variable interest rates drop below fixed term interest rates, which would really be quite something in the history of New Zealand's housing market, where for the last 4 or 5 years we've been in love with fixed term mortgage rates, particularly those longer term ones. For term depositors, this is not such good news, obviously. We're going to see term deposit rates fall quite substantially. So for those people who are looking to roll over their term deposit, you'd want to look to go long and stay long, because that's where the higher interest rates are. I'm Bernard Hickey. That was a special economic weather report brought to you in association with ASB from here at the Reserve Bank building in Wellington.